Good morning, everybody. Hope everyone is doing well. I think before I get started, I'd just like to thank all of you for taking time out of your schedule to listen to me speak and pontificate for a little while. Obviously, I'd like to thank Sushil for putting together such a wonderful Conclave event. It's been fascinating from what I've seen so far. So maybe give a quick hand and then a round of thanks to Sushil for putting this together. So today, I think we've got roughly about an hour for me to speak here. But I thought what we would do is I'll tell you a little about what I do, what we do at Bank of America Merrill Lynch, how we go about with our thought process, I try to identify what we think is going on around the world in financial markets, and how we try to come up with trade ideas from which to try to generate some kind of revenue stream or some kind of alpha from those ideas and thoughts. And from there, I'll go through a couple of key charts that I think are particularly relevant. Things that we think have some promising opportunities for the course of the next couple months, next quarter or so. And I think from there, we'd probably wrap it up with some questions, just some general Q&A. So with that, I think one of the big things, whenever I go around and I present to clients or I meet people for the first time, is if you think about technical analysis, if you look at the chartered market designation, the CMT designation from the Market Technicians Association, for those of you who are familiar with the CMT designation and the CMT exam process, right? It's a multifaceted, multi-year exam process, one in which there are hundreds of different technical tools, indicators, chart patterns, et cetera, from which you can try to employ and derive trade ideas. So one of the big things when it comes to technicals, or frankly for any technical or investment thought process, one of the things I suggest to clients is that you don't look at every indicator under the sun, right? Because if you think about it, if you look at every technical indicator in the universe on a particular stock or sector or currency or what have you, you're going to have a variety of them that say buy, a variety of them that say sell, and then a variety that say do nothing, right? So effectively you end up with a thing called analysis paralysis. What I think is key is that you develop over time a key set of indicators, 3, 4, 5, 6, whatever that number may be, from which you can take those tools, those indicators, and say, that is an opportunity I want to get involved in. That is a great setup. No, nothing. Stay the hell away from it. Right? You need a process from which you can say, that is really interesting. That's something I have confidence in. That's something that I can effectively try, there's an idea that I can try to generate alpha from. So the key is not to look at every indicator out there. The key is to look at a series of indicators and tools from which you can say, all right, that process makes sense for me. I'm going to stick with it, especially as you go through the drawdown process, right? Because anybody who's going to trade, and as all of you guys know, that at certain points in time, no matter how hard you work and no matter how good the signals look, it's just not going to work out, right? And you're going to go through a significant period of drawdown. And then you get in the whole concept of risk management and how you manage those losses. But the key is you need a process or a process from which you can say, all right, even though it's not working out, I still have faith in that process, right? So some of you might say, look, I really like momentum and I don't like looking at traditional pattern recognition. I'm a huge believer in Elliott wave. I think Elliott wave, intermarket analysis, momentum and sentiment, not momentum and sentiment, sentiment and positioning, those three things are paramount to what I do. So before I get started, I'll say how I walk through my process. So whenever I meet clients, I say, look, here's what we do. Here's how we come up with trade ideas. First and foremost, we can break it down into 3 buckets. The first bucket is traditional technical tools, pattern recognition, if you will, Fibonacci analysis, both retracement and projection, moving averages, some kind of momentum analysis. The big part, though, would be Elliott wave. I am a huge, huge believer in Elliott wave analysis. Some people love it. Some people hate it. I love it. I think, frankly, not that I'd ever want to be in this camp, but if there was one technical tool I could employ without any other, it would be Elliott wave. Hands down, no debate about it. And the reason why I like Elliott is for a couple reasons. One, it puts current price action within the context of the larger trend. I think most of us would agree that if we go back and we look at our historical P&L and we look at our biggest success versus our biggest losers, or just in general the whole continuum of winners to losers, most of the time we'd find out that our biggest trades come from trading with the trend. So Elliott wave keeps me within the direction of the larger trend. Secondly, it does a better job, I think, at identifying the age or the strength of that trend. Certainly, momentum analysis, relative strength analysis will help with that as well. But Elliott will effectively say, look, within the context of this trend, which you usually break down into a sequence of 5-wave moves, it'll tell you where you are within that trend. And then finally, and perhaps most importantly, it provides, I think, the best risk-rewards trade setups out there. Whenever we put a trade recommendation out, we need a minimum of a reward to risk of 3 to 1. Elliott wave, I think, does a better job of that than any other tool out there. Elliott wave can allow you to create, because of its hard and fast rules and its guidelines, but specifically its hard and fast rules, will allow you to create trade setups that can be 10 to 1, 15 to 1 reward to risk. Certainly, it's not going to happen every day, but it does happen. And I think we spoke, for those of you who saw the roundtable discussion or the panel discussion we did yesterday on FX and fixed income, when we spoke about the head and shoulders base setup in the Indian rupee or in dollar rupee, one of the things was, what do you think about, they asked me, what do you think about head and shoulders bases? I said, all right, I like traditional pattern recognition, those, put forward by Edwards and McGee. I like them a lot. I think they're a very good tool for identifying general trend and a good starting place from which to do your analysis. But from a risk-reward perspective, they're nowhere near good enough for my liking as opposed to Elliott wave. So I'll look at traditional pattern recognition, but the Elliott wave is what's going to say, now I'm going to step up and act, and I'm going to try to trade this. So maybe a little bit of a long-winded point, but I'm a huge believer in Elliott wave. The second bucket of my analysis, outside of traditional technical tools, we look at a lot of positioning and sentiment. And that can run the gamut from just effectively talking to a group of people in the market, like all of us here, and saying what's general consensus on a specific market or asset class or index, right? Is there general consensus surrounding that? That doesn't mean I necessarily want to fade consensus. Certainly consensus is what drives a trend, but as a guy by the name of Ned Davis has written, you want to be aware of the crowded extremes. So I'm constantly recognizing or trying to figure out what's going on from a sentiment perspective. In conjunction with that, I also look at a lot of positioning. Positioning can run the range of what Bank of America research publishes or to the CFTC commitment of trader statistics that's put out by the US CFTC Commission for futures markets, for all the futures markets that are traded within the United States. But I want to look at positioning and sentiment, because one of the interesting things is when you have significant sentiment in one direction, like everybody's bullish, but positioning is not there, that's traditionally a really, really enormous setup. So if you look at those two things and you get that divergence between big time sentiment, little positioning, and then you get a pattern setup, which, three things you need to see, you can have a phenomenal trade opportunity on your hands. And then finally, the final piece of the puzzle is intermarket analysis, right? Intermarket analysis, I guess probably easiest to describe it is with an example.